Coming up today, stocks trade mixed ahead of the biggest interest rate call in years. With the most market uncertainty on record, is Jay going to start small or go big? Why I disagree with the market and think he's only going to cut 25 basis points? What could happen to the stock market afterwards? Did Bitcoin just front run the move? Israel targets Hezbollah with exploding pages, and all the knock-on effects to commodity markets and much more. You don't want to miss this one, guys. Let's go. And here we are, guys, on rate cut eve. Federal Reserve set to release their decision 2 p.m. Eastern time tomorrow. Then we'll get the presser 30 minutes later. Early this morning, it looked like the market was front-running that move, gapping up quite big. Futures are up over 1%, with S&P 500 trading quite poetic and just finding new all-time highs by only 1 point before reversing later on in the day. And stick with me today, because I'm going to make a case to you why I think Jay Powell will only cut by 0.25% tomorrow, not the widely anticipated 0.5% that the market and many others are actually calling for. And I know a few of you watching this now are calling for a 50 basis point cut, which you may indeed be right. However, like I said, I'm going to tell you why I think Jay will cut 25 basis points, or at least why he should cut 25 basis points. Quite a political football he's got in his hand right now, right in front of the election, along with the stock market sitting right at all-time highs. I'm also going to show you what the stock market could do in response to the rate cuts tomorrow and going forward. Also going to show you the really unusual way Israel just targeted Hezbollah, something we've never really seen before. And as usual, we'll perform some technical analysis all across key markets to give you the bird's eye view of everything that's happening going in to this really big day tomorrow, as investors large and small position themselves ahead of this new easing cycle. Cost of capital in America just about to come down, and this has big implications and knock-on effects all across markets and into the real economy with consumers as well. And so this has got to be one of the most highly anticipated Fed rate decisions I've seen in years and years tomorrow. But I'd say almost equal amount of people on either side of the fence of how big they're going to go, 25 basis points or 50 basis points. There's definitely strong arguments to be made both ways. In fact, just looking at the implied probabilities from Fed Fund futures, going into this, they are the most uncertain of what's going to happen on record. I'd say Jay Powell and even his team have probably had some uncertainty over the last couple of weeks, deciding what to do. It's really a fine balance. If they go 50 basis points, they risk reigniting inflation. However, they bring down the risks of a severe recession. Or do they start small and reduce the risks of inflation, however, may increase the risks of a severity of a recession if they don't move quick enough. Markets can move quickly, and they don't meet again for almost 2 months later on the 7th of November. And they definitely don't want to have to do an emergency rate cut before then if economic data starts falling off the cliff. So he's really in between a rock and a hard place. And maybe a 50 basis point cut is the path of least regret if the jobs market were to significantly soften over the coming month or two, because he doesn't want to have egg on his face if he starts small and then things start really taking a turn for the worse. And plenty of people in the industry are saying the Fed is already behind the curve, like Jeffrey Gundlach, billionaire bond fund manager, saying the Fed's going to cut by 0.5 point tomorrow. In fact, he thinks they're going to cut by 125 basis points by the end of the year. We even got America's largest bank, JPMorgan, sticking to their 50 basis point rate cut call, saying that the Fed will do the right thing and cut by 0.5%. And that's what the market's calling for as well. Fed Fund futures going into it tomorrow, they're pricing 63% chance the Fed's going to cut 50 basis points, only 37% chance they're going to go 25. However, I'm going to leave my final odds going into it. It's pretty much the opposite. I'm going to go 60 for a 25 basis point cut and 40% chance they'll go 50 basis point cut. And as many of my regular viewers know, I've been calling for a 25 basis point cut in September for the last 3 months. So I'm going to see that call all the way through, whether I'm right or wrong. And just to be clear, I'm not definitely saying I'm going to be right. That's why I'm giving it a 60% chance. I very well could be wrong. I'm also not saying you have to agree with me. I'm also interested to hear your thoughts on this. You're welcome to post a comment below this video and let me know if you agree with me or disagree with me. That's fine. We can have an intellectual conversation about it and discuss the key data points. There is a lot of moving parts and variables. And so I just want to make that clear. I'm not saying I'm 100% right, as nobody is 100% right in trading and investing. And like Peter Lynch, one of the best fund managers of all time, famously said, if you're right 60% of the time in this business, then you're exceptional. So let me make my case why I think the Fed will, or at least should, start off with 25 basis points tomorrow afternoon. The first being retail sales. Now I know this is just one data print today, however, just looking at the overall trend, it's still holding up. Even though I know a lot of consumers out there are struggling, just looking at the overall market, even if it is the top 20-30% holding it up. If we're to believe the numbers coming out from the Census Bureau, then retail sales increased 0.1% in August from July, and that was doing a lot better than expectations from economists, who were actually expecting a 0.2% decrease. July's figures were also revised upwards to 1.1 from 1%, and so on an annual basis, sales rose 2.1%. Not absolutely fantastic, especially when adjusting for inflation, but also not falling off a cliff either. We also just got industrial production numbers today, with it too increasing more than expected in August. However, month over month came in at 0.8%, well ahead of expectations of 0.2% and better than the previous read we got as well, which was actually negative. And that actually caused Goldman Sachs to increase their Q3 GDP estimate to an annualized rate of 2.9%, meaning they don't see the economy contracting just around the corner or anytime soon. That's quite a far way away from the negative level it needs to actually be in a recession. And of course, GDP is a lagging indicator. However, Goldman Sachs, they're given their tracking estimates going forward based on a myriad of data. And in fact, just looking at the Federal Reserve's Bank of Atlanta website and their GDP Now forecasting model, which also gives a forecast of GDP going forward, they just came out today and increased it as well. Now seeing GDP growth in the third quarter tracking at an annualized rate of 3%, even better than Goldman Sachs' 2.8%, and that's up from 2.5% a week ago. So in other words, GDP estimates are tracking up, not down. They see the economy expanding. And so even though there is definitely some softness in the jobs market, unemployment rate is curling upwards, the fact is it's still well within the Fed's mandate under 5%. Inflation's not actually on a headline print CPI down at the lower twos just yet. We just crossed 3 recently. Credit markets are not freezing up. High yield bonds are actually breaking out to 52-week highs, suggesting they're looking forward to lower interest rates while the economy still holds up. And I know it's against consensus, however, there is still the chance of a continued soft landing scenario. And just looking at the economy overall, key indicators. And for my last point, the Fed wants to be apolitical. Jay says politics doesn't play into his decision making. However, I think he might be actually worried if he does go 50 basis points, it looks like a really political move right in front of the election and could send the wrong signal to the economy and to the market that the Fed's really worried about things falling off a cliff here. And starting with 50 basis points could also be an admission that he waited too long. And starting big's usually reserved for when things are really melting away, like we saw in the GFC. We saw after tech bubble burst. I mean, we got the stock market and the real estate market sitting at all-time highs. Nothing wrong in the credit markets. Unemployment rate 4.2%. Last CPI print in the high 2s. And then senators like Elizabeth Warren are screaming out for a 75 basis point cut? I don't think so. He's probably best to leave some ammo in the bag, so if things do get bad, he's got more basis points to work with. Then he can come out with a big cut. However, there's no need for an emergency or to scramble right now, in my opinion. I'm just speaking for what I see, and if I were Jay Powell, I would start with 25 basis points. But like I said, of course I could be wrong. I just think the odds favor starting 25 basis points. But that being said, of course, I wouldn't be surprised if he does go 50. I don't think it's necessary. However, the market and certainly many other people are calling for it, in which they could for sure be right. If he comes out and cuts 50 basis points tomorrow, I'll be the first one to say that I was wrong and the market and everybody else was right. However, at this stage, I'm going to stick to my contrarian view and go against the market pricing and think you'll most likely, but not by much, start off small tomorrow. So make sure you come back to the Click Capital channel tomorrow and you can see whether I was right or wrong. And of course, you're always welcome to let me know your opinion and how you see things. I'm always interested to hear your thoughts on all this as well. But just looking at the price action of key markets going into tomorrow, we actually got a little bump up in treasury yields today, which is also telling me maybe the market is second guessing its heavy odds of a 50 basis point cut, even though we're still in a really pronounced and swift downtrend in yield. Like I said, it wouldn't be that surprising if he does start big, because I mean, just look at that 2-year yield over the last couple of months. Absolutely front run what could be actually half of the entire easing cycle over the next year. Looking at the 2-year at 360, just bumped up a little bit there today. Same with the 10-year at 364. And I guess if they only did go 25 basis points, the contrarian play may be to actually sell bonds. They might pull back tomorrow, like the rate sensitive ETF TLT. Because like I said, it could be a case of just a massive pile-on into short-dated bonds, as no one wants to own long-dated bonds anymore. You look at Warren Buffett, he's got almost $300 billion, pretty much all of it's in short-dated bonds. He owns next to nothing in duration. And it was this price action that was kind of giving me the heads up that the Fed was on the cusp of cutting. And I know at first glance, this looks like the market's screaming out recession, really deep, dark one. However, like I always say, we can't rule out the possibility of a continued soft landing either. Could also just be the market pricing in inflation coming down really swiftly, which it has been of late, thanks to crude oil. And that rates are going to come down thanks to inflation while the economy keeps on growing. And that's why we've got high yield bonds actually on a tear, doing even better than Treasury, because they're not worried about defaults on the issuers of these bonds, they expect them to keep paying. And so if economic growth holds up with lower rates, well, then that's a great place to be for high yield bonds, especially when the starting valuation was a dividend yield over 5%. And stick with me because a bit later on, I'm going to show you some interesting price action coming out in currencies and commodities, as they could also be taking a bit of a turn going into the start of this new easing cycle. And so I'd say a big consensus trade out there has been to get into short-term bonds. However, there may not be much meat left on the bone unless we really go into that deep, dark recession. So looking back in history, if we don't get that recession, then you can expect yields to jump back up over the next year, meaning bonds will go down, as there's an inverted relationship between bond yields and bond prices. And like we can see here in the current orange line of bond yields going into it, they've absolutely nosedived the last 3-4 months. Those getting into short-term bonds now may be a little late to the party. And like I said, all this is coming when the S&P 500 is sitting literally at all-time highs. And it'll be interesting to see the S&P's reaction tomorrow. If he does only go 25 basis points, will the market sell off because it's been really hoping and pricing for 50 basis points? There could definitely be some volatility up and down on the initial reaction. What about if he goes 50? Will there be a big rip and rally like we saw in September 2007? Like I said, one of the most anticipated Fed calls and market days of the year, if not quite a few years actually. Morgan Stanley lays out the stock market's best case scenario for this week's Fed decision, 2 areas to buy after the cut. They also said the Fed will cut rates by 0.5 point without triggering growth worries, and that Mike Wilson noted the bond market is acting like the Fed is behind the curve. He said defensive and quality stocks are worth owning after the rate cut on Wednesday. He's been calling to pull away from the AI growth trade and position more defensively. Let's see if he's right this time. He also supports large caps over small caps, and that defensives tend to outperform cyclicals fairly persistently both before and after the cut. We also got some other research saying history says Fed interest rate cuts sets up a crapshoot for stock market investors, and that there's no real consistent pattern in stock returns following Fed rate cuts. And even though we sit here looking at historical data, facts, and statistics all day, like I say, there's always key differences. There's never a complete mirror and duplication of a past scenario. But nonetheless, it's the best we've got to go off, and it's not a bad idea to keep in the back of your mind what can happen, what has happened, what is a range of possible outcome. Just looking at the S&P 500 returns after rate cuts, on average, markets lower 3 months later 1.1%, higher 6 months later by 4.4%, and higher a year later by 4.9%. However, there's a big difference between hard cuts and soft cuts. A hard cut, a big cut like 50 basis points, typically associated with a deteriorating economy and stock market. A soft cut, typically associated with a strong economy and better stock market return. And I know this is a bit of a blurry chart, but basically this shows what happens when the Fed is cut with stocks at all-time highs, as defined by the S&P being within 2% of its all-time high. Looking back in history, that's happened 20 times before. Straight away, there's quite a bit of volatility in the first month or two. Market can consolidate, go up or down before it really decides, are we on a growth path or are we on a recession path? However, with the stock market sitting at all-time highs going into rate cuts, looking back in history, those 20 times it's occurred, a year later, the market is higher 100% of the time. Is this time going to be different? And like I said, there's always key differences each and every time. Just got an interesting meme posted on X today from billionaire Mark Andreessen, who runs one of the world's largest venture capital firms. In fact, he was part of founding Netscape, first web browser for the internet back in the early 90s. He points to key risks like World War III, which a lot of people are underestimating how close we are to that. Socialists, and Jim Cramer saying he's bullish, with an annotation for his investments, sweating on the way inside to all this. JPMorgan, who's calling for a 50 basis point cut, said investors should brace for lower stock market returns over the next decade, and that older investors may favor bonds over stocks, potentially lowering their equity allocations as more and more baby boomers retire. They point to current high valuations, suggesting future returns might be lower, with S&P 500's price-to-earnings ratio 25% above its 35-year average, and that historically, stock valuations tend to revert to the mean. They said corporate growth bound to slow down after the post-pandemic spurt we've seen, and potentially rising corporate taxes could stress profit margins, along with increased government antitrust actions, political instability, de-dollarization, and other knock-on effects from socialist policies. But it's interesting, just looking at the Bank of America Global Fund Manager Survey, long the Mag 7 still remains the most created trade, even though it is pulling back here in the dark blue September, light blue August this year, and in the grey July. Also interesting, we're seeing an increased bet against China, short Chinese equities. Fund managers are starting to come around to gold, slightly trimming their positions in 2-year bonds, increasing their position in corporate bonds, and significantly pulling back their position in the short Japanese yen, the carry trade. And we're seeing that in yen futures as well, with the latest positioning from CFTC, with the positioning here in the grey inverted chart level and the dollar yen in the red. In other words, big speculators, big money is getting long the Japanese yen, the anti-carry trade. And here's a look at yen futures. As you can see, pretty much gone parabolic this last couple of months. A lot of volume coming in and just going out to a monthly chart. This is coming off multi-year lows. This yen carry trade unwind could still have a lot further to go, as I recently showed on the Big Mac index. Japanese yen is significantly undervalued fundamentally. However, it's not just the yen. It's more of a case of a weak US dollar, because look at Euro FX futures as well. Strong signs of accumulation, uptrending, and we're starting to see some signs of accumulation, potential bottoms and moves up off those bottoms in commodity markets, which have been weak for a few months. Really helped inflation come down. There's soybean futures, corn futures having a bit of a pop. There's wheat trading up, sugar actually ripping up today on volume, coffee actually breaking out to new 52-week highs. The really hot cocoa trade at the start of this year, still consolidating somewhat. Bit of a bump up yesterday for cotton. There's copper, just slightly ticking higher. Orange juice trading up, gas still really weak, crude just having a bounce the last few days. Silver tracking back to 52-week highs, and of course we all know about gold sitting pretty as well. And so like I said, it's not just the Japanese yen that's strengthening, it's more of a case of the US dollar weakening, which is still currently sitting at this big support level. Market looking to see whether we can bounce from here, or will it give way and we potentially get confirmation of a new downtrend, giving further tailwinds to commodities and international stocks. But also just looking at this interesting chart here, once again from the Bank of America and their global fund manager survey. In the dark blue, the net percentage of them expecting a stronger economy in the next 12 months. Overlaid in the light blue, the S&P 500's year-over-year percentage change. And so it's a little bit contrarian, as usual, what most of the market thinks. Quite often the opposite can happen. We saw that in late 2000. We see as people get really pessimistic and expect a weaker economy, it's often near the lows of the market. Then when they're really optimistic on expecting a stronger economy, the market can then pull back. And we really saw that in mid-late 2022. There was really palpable pessimism in the market lows. Fund managers overall are still really pessimistic, especially when it comes to China. In fact, we're at multi-year lows. The amount of people expecting a stronger Chinese economy. Also interesting today to see a pop-up in Bitcoin. Really a bit of a political football. However, it's acting like gold, anticipating a lower rate environment is beneficial for these anti-fiat currencies. With it maybe pricing in a 50 basis point cut today, maybe getting a little excited. And so I'd say Bitcoin is more linked to liquidity and sentiment and risk on kind of regimes in the market than gold. We've seen a lot of correlation with Bitcoin and the NASDAQ meme stocks over the last couple of years. And so if we do get that continued soft landing with rate cuts, that could be maybe even more beneficial to Bitcoin instead of gold, even after adjusting for beta, as Bitcoin's obviously a lot more volatile than gold. And just moving on to something you may have also just heard about, just hitting the news wires. Hezbollah accuses Israel as thousands hurt in unusual pager blasts. At least 8 people have been killed and a huge 2,750 have been injured as Israelis target the militant group of Hezbollah and their key members, causing pages to belong to them of actually just blowing up right in their pocket or as they hold it. And just looking at some social commentary coming out from this attack from the open source intelligence monitor, if this attack was committed by Israel, it is beyond unprecedented and it totally changes how asymmetric and unconventional warfare will take place across the Middle East in the future. We also got open source intel. This is possibly the largest military attack in history with the least civilian damage. With them also going on to say, a Hezbollah intelligence official has stated that the encrypted pages were set to beep beep several times before then exploding near the head or abdomen of the victim, with the explosion believed now to have originated from within the lithium battery of the pager. With another person saying Israel managing to hack Hezbollah pages, which the terrorists used to communicate and avoid being tracked as they got rid of all their mobile phones, as Israel was using them to track and strike key officials. They all went onto pages and simultaneously explode all of them as one of the baddest ass counterterrorism moves of all time. Even billionaire hedge fund manager chiming in on it, saying going forward, terrorists will no longer use devices that have chips and lithium batteries. That should be a hit to their productivity and effectiveness. With the intelligence monitor also going on, if this doesn't lead to full-scale war between Israel and Hezbollah, I don't think anything ever will. And so what a clever way for the Israelis to attack their enemy. A lot of people underestimate how technologically savvy the Israelis are, head and shoulders above anyone else in the region, and they've just proven that once again today. With their precise and targeted attack, current admin's really hoping things will cool down there going into the election. But once again, the Israelis are not willing to back down. And this is probably what's keeping a bit of a geopolitical premium in gold and maybe coming a little bit back to oil, as this still has the potential to blow up into a full-scale regional war. America still has a record amount of military assets in the region, ready to respond to a large-scale attack from Iran, and oil definitely seems to have found support on those mid-60s level, which, looking at the weekly chart, is a key area where the market has turned a number of times before. We saw that early last year. And so if all these commodities bounce back and the Fed does cut by 50 basis points, we're just setting up for resurgence in inflation next year. And in fact, the 50 basis point cut would actually benefit me the most in my portfolio, probably just the stock market in general, but also the potential resurgence of inflation, popping up commodities, weakening the US dollar that helps international stocks, which I'm also invested in. So don't get me wrong, I won't be upset if the Fed cuts by 50 basis points. I'm just going off the data and giving you my honest opinion that I think they'll most likely go 25. And there's a look at the agricultural commodity fund, actually tracking up to 52-week highs as well. So surely I think Jay Powell's got to be mindful of the risks to inflation coming back that he has to balance out with trying to get in front of a potential recession. Like I said, the economy is not really diving off a cliff right here and now. There's no real present emergency. He started off the whole rate hiking cycle with 25 basis points. Why can't he start off easing the same? He didn't even blink in the regional banking crisis early last year as well. Looked like things were falling off a cliff. He actually kept on hiking, showing that he does have some guts to stay the path. And like I said, maybe it's just the market really pricing in low inflation. And let's not forget, no market's right 100% of the time. Even government bonds can be wrong. We can see swift repricing, and that's how you get big moves in the market. All markets are pretty much trying to price in what's around the corner. 3 months out, 6 months out, 12 months out. However, if what materializes is different than what's priced, that's how you get those big moves in the market, the repricing. Because one of these markets is wrong. Is it high yield corporate bonds? Are we already in a recession, like Jeffrey Gundlach says? Because if so, these should then fall off a cliff, just like they did back in 2008. High yield bonds got smashed. And so once again, I'm hard pressed to find any decent article to do with gold across financial media. And this isn't just a conspiracy of mine. It's actually backed up by data. Looking at a chart here, over the last 7 years, price of gold here in the blue line, as we all know, sitting at all-time highs. However, in the white bars here is the amount of stories across media about gold. And it's interesting, isn't it? Currently sitting near multi-year lows, almost like an inverse relationship. When gold was flat, a lot of the media was talking about it. However, in general, since early 2021, that's been downtrending. The media is talking less and less about gold these last couple of years than prior to that, whereas it should be at all-time highs. Big key market like gold breaking out, the media should be all over it like a rash. However, not so much. And another bullish thing for a lot of commodity markets is we're getting big divergence in the price of oil and these commodities, because a lot of miners use a lot of oil to dig all their minerals and metals out of the ground, really energy-intensive operations. And so when you've got oil coming down, which pulls down a lot of things, the cost of digging goes down, while the price you can sell your goods at goes up. That just increases profit margins. And so hopefully AI and increased oil supply keeps the price of oil really low for years ahead, while the infinite supply of US dollars helps to propel other commodities higher and higher. That's just going to further increase mining margins. And as they're coming off multi-decade lows and valuation metrics, that just adds to my bullish thesis for being invested in commodities going forward. And just rounding out my market analysis today with a bit of insight on the world's richest men. Seen a big jump up lately of Larry Ellison from Oracle. The guy's looking really good for 80 years old. At the top of his game, he owns a lot of Tesla shares. He's been a big believer in Elon Musk for a long time. And of course, he founded the #1 database company in the world, Oracle, getting in on the AI boom, been a large beneficiary of the cloud, and his stock ripping up to all-time highs, making him the 4th richest person in the world, only after Elon Musk, Jeff Bezos, Mark Zuckerberg, got Bernard Arnault of Louis Vuitton, Gates and Balmer, Microsoft, Larry Page, Sergey Brin, Alphabet, Google, Warren Buffett, Amancio Ortega, big retailer coming out of Spain, Mukesh Ambani, energy conglomerate out of India. Dell's still up there. Jim Walton of Walmart, coming in number 15. Jensen Huang, Nvidia, all worth above $100 billion. Interesting, out of the top 15 richest men, 10 of them come from the technology sector. Also interesting, quite a few of these companies were only created in the last 20, 30 years. Look at Mark Zuckerberg. He only came onto the market a bit over 10 years ago. Unfortunately, I can't present the same prosperity for younger people. Even though over the last 20, 30 years, we've seen the biggest expansion in capital markets, stock market, real estate. The 1% never been as rich. The federal government never has spent as much, never been in as much debt. Federal Reserve never printed as much money. All of that stuff highly inflated the pie, just not for everybody. And we can see that in the share of US 30-year-olds. And again, this is not just in America. This is largely across the West. You'll see the same trends. Who are living on their own going down, meaning they're still living with their parents. And looking over the last 40 years, the percent that have ever married, now below half. Less and less millennials having children, now getting down to the low 30s, 30-year-olds, and a percent that own their own home, also down towards 30%. So have we seen the bottom in these trends, or are they going to keep going down towards zero while the top 1% keep going up to 100? And will something eventually break and cause this to reverse? Or are we going to keep living with corporate and government socialism and capitalism for the rest of us? All right, guys, that pretty much wraps it up for today. On the eve of the first rate cut in this new easing cycle. Is Jay Powell going to start small, 25 basis points, or is he going to go big with 50 basis points? I've made it clear what my opinion is. Unlike others, I won't sit on the fence and play it safe. I'm going to put my neck out there, take the contrarian bet, go against the market, go against JPMorgan, go against Billionaires, Jeffrey Gunlock, and I'm going to say 25 basis points. Of course, I could be wrong. I'll be the first to admit it tomorrow if I am. However, at this stage, I think the odds slightly favor 25 basis points. You're welcome to disagree with me and offer some constructive criticism. Let me know what your thoughts are, why you think they may go 50, or why you may think they'll go 25 like I do. Thanks again for watching Click Capital, and I look forward to diving in and breaking down all the action and moves we get out of markets tomorrow. It's going to be a good one, guys. I'll see you then. Cheers.